And Excel A-level business student book 2 we'd need, right? Book 2.
Yeah.
Mm, I need to start sharing my screen with you. Okay. And I need to open the set board as well. Hmm. Mm, so how much do we have left? Interpretation of financial statements and then ratio analysis. Good. 133. Uh, Ethics we have discussed. Financial statements we discussed. Current liabilities discussed. Non-current liabilities discussed. Net assets discussed. Okay, in net assets, then I have to explain this equity, share capital, share premium, other reserves, and retained earnings. All right. So these are the reserves that are there in the net asset or the equity account. Hopefully, what I'm saying is making sense to you.
Yeah.
Concept verb law rotation. Hmm. Login. Um, Login. Okay. Level business. Hmm. Hmm. Alhamdulillah.
Bless you, sir.
Yeah. Hmm. Hmm. Hmm.
Bless you.
Okay. What else do I need? I need this. Control T, Control V, enter. Okay. Net assets. Okay. So we are starting at around at 15. Okay. Share equity. So within equity, the first thing that we have got is share capital. Share capital. What is share capital? Share capital, we know, first of all, it comes from shares. Shares are the instruments which are issued against ownership in a business. So, for share capital, it would have the shareholders of the business. How do they become shareholders? They get share capital. So, share capital is a document which would tell the number of shares that a person holds. So, for example, you have 500 shares, 1000 shares, whatever number of shares you have, and it would in fact give you that from the total shares of the business, from this number to this number belongs to this person. And these shares, they would have a face value or what we call par value, face value or par
Par value.
value. Okay. So, for example, in Pakistan, all the shares that are issued at for rupees 10. Each share is for rupees 10. In USA, I believe every share that is issued has a face value of $1. Okay.
Yeah.
So all the money, for example, if I buy 500 shares, it would mean I would have bought share capital worth 5,000, and that 5,000 would appear in the share capital section of the balance sheet, statement of financial position. And this wouldn't be for just one person, it would be for all the shareholders of the business, the total investment that they have made at face value or par value of shares that would appear in the share capital account. Is it clear?
Yeah. Yep.
Okay. Then a business, it might say that my particular share, it's worth more than rupees 10. Rupees 10 is for normal businesses. If I issue shares, I would issue them for, let's say, rupees 12. Or a businessman in USA might say that this dollar one is for ordinary businesses. My shares, I am a very profitable business. I would issue these shares at dollar 1.3. So this point 3 or these two extra rupees that I'm selling my share for, the amount that I'm charging per share over and above face value or par value is called share premium.
Yeah.
Did you already know this thing?
No.
So all the shares issued at premium, it could be that the business, it could issue shares. For example, we know for a public limited company there is no limitation on the number of times it can sell shares. If it meets the regulatory requirements, it can issue shares as many times as it wishes to. So, and business during the course of its operation, they're down the road, many a times they are offering more shares. Okay, so these shares, so it could be that sometimes a business, it or the shares it offers, it's for premium, it's at a premium price, and sometimes these shares they are issued at par value. All right.
Yeah.
Okay, so all the time you issued shares at premium, the amount of premium would go to the share premium account, and the amount that you received up to face value or par value would go to the share capital account. It would be reflected in the share capital account. So let's say a business, it just start, hypothetical situation, it's not practical but just to understand it. If a business issues just one share for dollar 1.3, dollar 1 would appear here in the share capital account and dollar 0.3 would appear here in the share premium account. All right.
Yeah.
So this is the function of this share premium account. Then the third thing that we have got in this equity is what we call, the next thing that we have got is what we call reserves. Reserves. So share, uh, all these other than this share capital account, all these accounts are reserves. Share premium is a reserve. And another famous or most often appearing reserve in the balance sheet or statement of financial position of a business is what we call retained earnings. And retained earnings, we have discussed before that this is the amount that the business has withheld from the profits. It has decided not to distribute among the shareholders as dividend, and this amount has been withheld and reinvested in the business. All right.
Yeah.
Okay. Other than retained earnings, sometimes a business might be required legally, or sometimes on its own initiative, it might maintain other reserves. So, from the profits of the business, they are setting money aside for a certain purpose. So, back when I was there at the National Refinery Limited, they were maintaining a reserve. There was a statutory requirement that they had to upgrade their refinery setup. Okay, and for that the government had said that this much of the cost of this upgradation project, it should be funded by the business from its own profits. The rest they can
Yes.
borrow, but up to this much amount they have to invest in that project from their own reserves. So from the retained earnings, they were setting some amount aside in this other reserves. So other reserves, all the money that a business is keeping, either because of statutory requirement or because of their own initiative, this money is being kept to for some later use. All right.
Yeah.
Okay. Then there is this question of what is stakeholders' interest in a business. We have partly discussed this thing before when we discussed the stakeholder concept, but let's quickly do it again. So stakeholders interest in business. So the first stakeholder that we always or usually discuss about are the shareholders. What is the shareholders' interest in the business? Or
Uh,
let's say, what would a shareholder use the financial information of the business for? How would a shareholder or how would all the
Calculate
stakeholders,
their dividends.
they'll be looking for profits because these profits they belong to the shareholders, and they'd see how much out of these profits is being given as dividend. What else?
Uh,
They would like to see if a business is still solvent. What solvent? That the business it will be able to meet its payment requirements in the future.
yeah.
So they're looking for solvency as well. What else would they look for?
Um, Dividends, solvency.
How would they know if a business is solvent or not? They'd be looking at the working capital of the business.
So
Working
what is
capital.
solvent?
What is what?
Solvent. Solvency.
Solvent is some solvency is the ability. Do you have the ability to pay back the liabilities that you have, or are your liabilities so huge that it appears you will not be able to pay them back?
Yeah.
Okay, so if you are able to pay back your liabilities, then you're solvent. If you are unable to pay back your liabilities, then you're insolvent. You'll be declared insolvent, or you'll fear insolvency in the future. Bankruptcy, what we call.
Yeah.
That's insolvency. So solvency can be checked by looking at the working capital. And how do we calculate the working capital of the business?
Uh, hmm, I'm not sure.
We discussed it
Sales.
before. So it is current assets minus current liabilities. Did I tell you this formula before?
That's the formula for net assets
That was total assets minus total
minus
liabilities.
liabilities.
So this is working capital and this is net assets. All right.
Yeah.
Okay. Another thing that you need to know, or perhaps you already know, is that the net assets they are the residual interest of owner in a business.
Yeah.
Residual interest of owners in business. So, from the total assets of the business, if we pay off all the liabilities, what remains is what belongs to the owner.
Yeah.
Okay. And the owners, they would also be interested in this particular amount, that how much is their stake in the business.
Yeah.
Okay. So, the next stakeholder group that we have got is managers and directors. How would they look? We are just discussing superficially the things that these people would be looking at. When we study the ratio analysis, we'd go in more depth of how they do the analysis. So managers and directors, what would they be looking at, especially in the statement of financial position of the business, which shows the assets, capital, and liabilities?
Uh,
So managers and directors, first of all, again, they will be looking at this solvency thing again. Since they are the ones managing the business, it is their job description that they run the business in smooth manner, and they see that the business it is able to stay afloat. It is able to pay off all the liabilities that it needs to pay off. Okay,
Yeah.
and they do not contract so many liabilities that the business wouldn't be able to pay off.
Yeah.
Okay, how would the suppliers of the business, or what would the suppliers of the business look at in the financial statements of the business?
The
Same solvency thing.
prestige.
Hmm. Same solvency thing. Right now, in your book, they have given this strange thing that they mention just with respect to the statement of financial position. What would these stakeholders be looking at? I think we did a more thorough discussion over this thing yesterday. Sometime back, yesterday or sometime back, we discussed that what would these different stakeholder groups they would be looking at in the financial statements. So,
Yeah.
for example, I remember having discussed this with you that stakeholders, this prestige thing, they would like to conduct business with, they'd like to do transactions with a business which is big enough. Also, they'd like to do transactions with a business which seemingly has the ability, they'll give credit to a business which has the ability to pay back the amount. If I know that somebody is going to make a default on the payment, I'm not going to do a credit transaction with that person, right?
Yeah.
Okay, so they'd also be looking at the profitability of the business. Basically, all of these people they would be interested in the ratio analysis, which is the next thing that we are about to study. How to do ratio analysis.
Yeah. It's math, right?
Ratio analysis is math in the sense.
Yeah.
Yes, we will be doing calculations. We will be doing calculations. Let's do it over here. Hmm. Have you done this at school?
And we're gonna start. Still didn't
Hmm.
start this.
Okay. In ratio analysis, we are trying to find a ratio between different components of financial statements so that we are able to create a picture about the business, or we are able to assess the performance of the business
This is financial ratios.
with these financial ratios. Yes, these are the financial ratios. Okay, so these ratios they are of two types. The first ones they are profitability ratios, and the other type is liquidity ratios. The name tells us the profitability ratios they tell us how profitable a business is, and the liquidity ratios they tell us how much cash is what's the cash position of the business. All right.
Yeah.
Okay. So in the profitability ratios, the first ratio that we look at is gross profit margin. So gross profit margin, sometimes we also call it GP margin. How do we calculate it?
Not sure.
Gross
Oh, the
profit,
gross profit times 100 divided by revenue.
gross profit over revenue times 100. Okay, so remember this thing. Whenever we are saying using the term margin, it means that thing is being divided by revenue.
Yeah.
Okay. So it tells me that per rupee or per dirham or per dollar of revenue that I've earned, how much of it is profit.
Yeah.
Okay. The next ratio that I have is, and obviously a business with higher gross profit margin is better. Agreed?
Yeah.
Okay. Another thing, if we Would you be able to? Yes, you'd be able to. Okay. So if I draw just an extract of balance sheet, sorry, the profit loss statement, the statement of comprehensive income. So I've got
Financial statement?
from financial statements, I'm drawing this extract of statement of profit or loss,
Oh, okay.
not statement of financial position or balance sheet. The other one.
Yeah.
Less cost of goods sold. Okay. This gives me gross profit. So if I want to increase the gross profit of the business, how can I do that? So let me in fact write actual numbers. So there is a business which made a sales of uh, कुछ भी नहीं हाँ थैंक यू एक बस हाँ ठीक थैंक gross profit. So a business which has made 100 or in fact better than that. Do they have an example? Okay, so there they here they have shown examples. Let me write. Okay, the way we'll do it first. Let us write the formula for both the ratios that we are going to calculate, and then we'll do the calculations. We'll do the worked example. So GP margin we have got. The other thing is net profit margin. Net profit margin. And how do I calculate net profit margin? Net profit over revenue times 100. All right.
Yeah.
Okay, so
Is that how
here,
to calculate net profit margin?
sorry,
Is that calculating net profit margin?
net profit margin,
And
the
what do
second
you
one.
need that for?
Uh, Net profit margin, let's just calculate it first, and then we'll discuss how it would help us. We'll discuss about it, how to interpret this as well. Okay, so we have got this business, this worked example, and in this worked example, we see that in 2007, the 2017 the revenue is 48,660, and 2016 the revenue is 48,050. So revenue has increased just a little bit. um it has increased by whatever. Can you calculate the gross profit and operating profit margin for both years? So I will write over here 2016, right over here 2017, and then I will write uh, GP margin, and then I will calculate right over here net profit margin, right?
Yeah.
Okay, give me these four values.
Gross profit for 2016 is 19,700.
Gross profit is
2016 is
19,700, fine,
yeah.
but what would be the gross profit margin?
You take that 19,700 times 100 divided by 48,050.
Okay, and the amount would be
Uh, 40.9.
40.9. Let's call it 41%. Okay, and for 2017, how much is it?
2017. 45. 44.9, which is 45.
45%. Okay, now let's look at how this gross profit is calculated, for which we have calculated the gross profit margin, and then maybe we can comment on if there is a way that a business can increase its gross profit margin. So we
Yeah.
have got revenue minus cost of goods sold is equal to gross profit. So if a business wants to increase its gross profit, And the other thing is that for gross profit margin, it is GP by revenue times 100. So if I want to improve my gross profit margin, either I will have to increase the gross profit without increasing the revenue a lot, right?
Yeah.
Or I will have to, if I keep earning the same gross profit, maybe I should do that with a lower revenue. So I have to maintain the gross profit and decrease the revenue. So in fact, what I have to do is I have to increase the gap between the revenue and the gross profit. If the gap between the revenue and gross profit grows, my gross profit margin would increase. Agreed?
Yes.
Okay. How can I increase the gap between the revenue and the gross profit?
Um.
Okay, listen carefully. I
Yeah.
so what we said was that in order to increase GP margin, we have to increase gap between GP and revenue. Okay. How we
Yeah.
can do that? We can do that in two ways. The first way is holding the costs right where they are, we increase the revenue.
Sorry.
Holding the costs of the business right where they are, if I increase the revenue, gross profit would increase.
Yeah.
Okay. And if I push the costs down and pull the revenue up, so costs are going down and revenue is increasing, then
Then GP margin will increase.
GP margin will increase.
Yeah.
Okay. So I have to hold the costs down and increase the revenue in order to increase the gross profit margin, or the price that I'm charging for a certain good, I might have to find ways where I can charge higher prices for the same good.
Yeah.
Okay. How can I do that? I can do that by creating a stronger brand power or making the demand for the goods price inelastic for the consumers.
Yeah.
Okay. Okay.
Yeah.
This is for gross profit margin. Let's quickly calculate the net profit margin for 2016 and 17. Net profit margin is again net profit over revenue into 100.
Yeah. Net profit margin is net profit times 100 divided by
Hmm.
revenue.
Hmm.
So for 2017,
Hmm.
uh, net profit is the wait, you calculate
Hmm. Profit for the year.
that's net profit.
Hmm. I told you that sometimes they use the term net profit for operating profit, and sometimes they use for profit for the year. And if both are given and it's not told that which one is the net profit, we will assume the profit for the year to be net profit.
Yeah. So what does net mean?
In general terms, when I say something is net of something, it means that I'm deducting something from it. Okay. So an example is gross revenue. Gross revenue.
Yeah.
Gross revenue is the amount for
And what
which
does gross mean?
gross means that it includes things which might have to be deducted to get to the final amount
Oh,
in absolute terms. So throughout the year, I sold goods worth 5 million.
Yeah.
Okay, this is all the goods that I ever sold during this year. Then out of all these goods that I sold, some I will get returned. There are sales returns. So those sales return was point 0.05 million. These are sales returns.
Yeah.
So in net, I'll say net sales is 5 minus 0.05, which will be 4.95 million.
Yeah.
Okay, so this is the difference between gross and net.
Yeah.
So net means the final figure from which all the deductions which I had to make have been deducted. Okay, so calculating net profit margin for okay, you can also get a question in your exams for operating profit margin. If they ask you operating profit margin, how would you do that?
Operating profit.
Hmm.
The
Operating profit margin.
take operating profit times
Hmm.
100
Hmm.
divided by revenue because margin is
Hmm.
revenue.
Hmm. Hmm. Margin is something divided by revenue. Excellent. Excellent. Okay. Then, sir.
Wait, that
Uh,
was operating profit margin, right?
hmm. Hmm.
Okay, because I'm writing the formulas.
Hmm.
So can you give me like a list of important formulas?
Uh, I
Because
made a list of
sometimes
hmm.
like the main formulas, because there's some formulas that you never use, you know?
You have got Excel on your system.
Yeah.
Microsoft Excel Business Economics. Okay, so I've got this sheet. There were just one or two errors in it. I made this sheet some time back. Do I have the chat open? How do I send it to you? No, I'll have to open the chat first. And if I now drag and drop, how do I send you a file? Could you type your email address here in the chat box?
And what's up?
WhatsApp would also do. I was talking
I
about here in
I
Google Meet.
can't find the. Oh yeah, yeah. Okay, okay, okay. My email.
Yes, please. Okay. I made this sheet originally for AS, but I mean for Cambridge A levels, but it
Yeah.
might be of use to you as well. What we will do is you can take a print of this sheet and just note the formula.
So you sent it already?
Not yet. Mm, Control C, Control T, Gmail. Ha, 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 Gmail, Gmail, Gmail. compose this D this Mhm. Okay, here and I paste mm, business formula sheet sent. So you can just highlight the formula that are relevant to you and ignore the rest.
Yeah.
Okay. Let me know when you've taken a print of this one. I'll just have you highlight the formulas that are relevant to this unit 3. All right.
Yes, sir. You said sorry.
Hmm?
Yeah, I got it.
And more important than memorizing these things, I always stress on learning the concept. So, for example, the concept that we learned for what's a margin, and the other thing, if a business it wants to increase, first of all, higher gross profit margin is better. It shows more profitability of the business. It shows that a business it can charge a higher price over its cost of goods sold, and it also shows that a business out of all the sales that it makes, a good portion is gross profit.
Yeah.
Okay, so that is why having higher gross profit margin is better for the business. The same is for net profit margin as well. So first let's calculate. So here they have done the calculation for you, and they have told you that for 2017 the net profit margin is 8.1%, and for 2016 the net profit margin is 7.2%.
Yeah.
Okay, now let's see from where do we get net profit, and let's see if there is a way we can uh, improve our net profit margin. So we have got mm, hmm, revenue less cost of goods sold. It gives me gross profit, and from gross profit, if I deduct operating expenses, I get operating profit.
Yeah.
And from operating profit, I deduct finance cost as well as taxation. I will get net profit. If I deduct just the finance cost, I get profit before tax. This operating profit, I told you, it's also called PBIT, profit before interest and tax. And from this profit before interest and tax, if I deduct just the finance cost, I'll get profit before tax. And if I deduct tax from that, I'll get profit after tax or net profit. Right?
Yeah.
We discussed this yesterday. Okay. Now we want to increase net profit of the business, and we have already talked about until gross profit. Obviously, if gross profit is more, then net profit would be more.
Yeah.
First thing. The second thing is, what can I do other than increasing gross profit, which can help me increase my net profit? I have to control my operating expenses. If for the same gross profit, I reduce the operating expenses, my net profit would go up and my net profit margin would go up.
Yeah.
Okay, so it's a matter of controlling the operating expenses. Another thing, there are some businesses which have a gross profit but operating loss.
Yeah.
So it means the product of the business is profitable. Product of the business is profitable, but the business is not being run in an efficient manner. The problem is in operating the business, it's not in the product. Because product is profitable, that is why you're having gross profit. Did you
Yeah.
get this thing?
Yeah.
Okay. Um, a business, it might continue if it's making operating loss or net loss. But a business should never continue if it's making gross loss,
Yeah.
because making gross loss means the product is not profitable. So there is no point in running the business. If there are operating losses, then it could be because you are not operating the business efficiently, or it could be because you're not selling enough goods. So if you increased your volume, it might be that your gross profits, they would increase with volume, and the operating expenses would be covered. The break even would be reached.
Yeah.
However, if the business is in gross loss, then such business should be shut down, usually.
Yes.
All right. These are the only these are the only profitability ratios that are given for your syllabus. The other ratios that we have are now liquidity ratios. And liquidity ratios, I told you, they tell you if the business, it has the ability to pay back the borrowings, the amounts that it has to pay back. Okay, so in liquidity ratios, the first one that we are going to look at is what we call current ratio. And how do we calculate current ratio?
Um.
Current assets over current liabilities.
So current assets over current liabilities.
Hmm. So it would be how many times of your current liabilities are your current assets.
Yeah.
So, for example, if you have got 500 million of current assets and 500 million of current liabilities, your ratio, it would come out as 1 is to 1. It means that you have got just enough current assets to pay off your liabilities. However, if you have got 1,000 million of current assets and just 500 million of current liabilities, then this ratio would come out as 2 is to 1, right?
Yeah.
Okay, as long as current assets, they are more than current liabilities, or this ratio is one or more, the business is seemingly fine, because it shows that whatever current liabilities you have got at least that much current assets. So current liabilities are the borrowings that you have to pay back within the next year, and current assets are the assets that would turn into cash in the next year. So using these assets, you can pay back these liabilities. What would happen if the current ratio of a business falls below 1?
Um.
What does it mean that current ratio of a business is less than 1? When would a business or which business would have its current
So I
ratio
don't
less than
understand.
1? Right now, there are figures, these amounts written on the screen, they show a business which has a current ratio of what's current ratio?
Um, Current assets over current liabilities.
So you're comparing the current assets of your business to current liabilities. If you get the answer as 1, what does that mean?
Then they're equal.
They're equal. If your answer is 1.1, what does that mean?
Then current assets are more valuable than the current liability.
They are slightly of more value as compared to current liabilities. It's not that they're more valuable, it's that their value is slightly more than that of total current liabilities that you have to
Yeah.
pay back. Okay. And what if it is 0.9?
Then liabilities are slightly more than
What
assets.
would happen if your current liabilities are slightly more than your current assets?
Lose money.
hmm What is current asset?
It's the assets that you have.
I've got also non-current
So
assets. What are current assets? What
there
was hmm.
you're gonna get money back.
Current assets are the assets which would convert into cash within next year.
Yeah.
What are current assets?
They will convert into cash over the next year.
Assets which are already cash or which would convert into cash within the next year. What are current liabilities?
Uh,
What is a liability?
Setback
No. Liability is the amount that you have to pay to someone. What is liability?
amount you have to pay to someone.
What is current liability?
The amount that you have to pay over the next year.
Within next year. Now,
So the
if
asset is the amount that you will get over the next year.
the amount, the
Or
assets
the
that you have, it will convert into cash. These assets you'll have in cash form within next year. By nature, these are such assets which would convert into cash, which would give you cash.
yeah.
Okay, so these assets they would convert into cash within next year, and using this cash, you will pay your current liabilities. Okay,
And current liabilities is the money that you owe, the
not
money
only
that
the
you
money
give
that you
out over
owe,
the
the money that
next
you owe, plus you have to pay it back within next year.
the money to be paid back over the next year.
Hmm, that is current liabilities.
Okay.
Okay, so now again, think about it. What would happen if current liabilities are slightly more than current assets? What would happen to the
Then
business?
you'll give more than you'll earn.
You will have to give more than you will. It's not that you will earn this money. These are the assets that you already have. For example, inventory. You're not going to earn your inventory within next year. You already have this
Sell it
inventory. It's just going to get sold,
into
and
cash.
when it gets sold, you will have cash instead of inventory.
Yeah.
The same way you have a building. Building is non-current asset. So you will have building as building at the end of the year. The building it will not be get sold and you'll have cash at the end of this year. The
Yeah.
building you have bought so that you continue business in it for 20, 50, 100 years.
Yeah.
Okay, so that is the difference between current assets and cash. You're not going to earn them. These are already your assets. These assets they will get converted into cash. Accounts receivable is your current asset. So account receivable you will receive money against that account receivable.
Yeah.
Okay, now again my question, what would happen if current liabilities are slightly more than current assets? A business, it will not be able to pay back all its liabilities. So for example, if a business has current assets of 75 million, and it has current liabilities of 100 million.
Yeah.
So it means there is 3 is to 4 ratio. A business will be able to pay back only 3 out of 4 liabilities. What about the remaining 1 over 4 liabilities? Did you get the problem?
The 3/4.
Hmm. I
Could
mean,
you repeat?
do you get it? What's the problem over here for the business?
That the liabilities are more than the assets.
Hmm. And what would happen if liabilities are more than the assets? We have to pay to someone and we don't have cash.
Yeah.
This is the
You
problem.
won't be able to earn the cash because you won't sell the assets.
Again?
You won't be able to get the cash because the assets that would be sold would be less than the liabilities.
Hmm. So, how will you pay this? I mean, this is their legal right. How will you pay this remaining amount then? I mean, just because you do not have money doesn't mean that the borrowers would stop asking for money. Sorry, lenders would stop asking for money.
Yeah.
They'd ask for their money. So, how would you pay it then? You will have to sell some of your non current assets.
Uh,
Okay, the
okay.
asset which you had in your business, which was earning revenues for you, which was to earn revenues for your business for next 20, 30, 40 years, you
You
will
have to
have
sell
to
that
sell that asset now for
to pay
cash
the
to
liabilities.
pay the liabilities. And it shows mismanagement of business. They
Because they
shouldn't
didn't
have
plan
they
the
didn't
selling of the
plan it
assets.
properly, and now they have to sell assets which were going to earn revenue from for them in the next
Yes,
years,
yes,
and now they do not have those assets.
yes,
Those assets were sold to settle this immediate cash.
yes.
So this is
So
what a
what's the
business.
definition of non-current assets?
Non-current assets are the assets which will not convert into cash within next accounting year.
So it's the assets that will keep earning money without being sold.
Hmm. But that's not the proper definition of uh, non-current assets. The proper definition is with reference to time frame.
Next year.
Within next year, would this asset continue to exist as asset, or would this asset convert into cash?
Yeah.
That is the benchmark of identifying an asset as current or non-current asset.
So it will continue to generate money over the next
It
couple of
will,
years.
again, I will repeat, it will not convert into
Into
cash,
cash
and
over the
hence
next year.
it exists in its existing form. It could be, for example, you're saying the why am I not accepting your definition that it will keep earning money for the business? If I've got a business building and
Yeah.
I leave that building vacant, I don't use it.
Yeah.
Is it earning money for me?
No.
Is it a non-current asset?
Yes, it's non-current.
It's still non-current asset if it's not earning, even if it's not earning money for me. Okay, that
Uh,
is why the use of earning money criteria is not a good way to define non-current asset.
so just assets that will not convert into money over the next year.
Hmm. Hmm.
Okay.
Okay. Uh, you understood this current ratio. You understood what this current ratio. So ideally, what to conclude from what we have discussed so far, at least 1:1 current ratio is good for business. That you have at
Yeah.
least the assets. What if I have a current ratio of 5:1?
And that's good.
Is it? What could be bad about it?
Wait, like
Five
the
current assets to
assets that
one
will
current liability.
the assets will the remaining assets will sit there, not being converted
Excellent,
into money.
excellent,
So it's like
excellent, excellent.
bad use of
Hmm,
management
hmm,
assets.
hmm, hmm. So again, that's
So it
bad
needs to be one
financial
to one.
management. It needs to be just enough to pay off your current liabilities. Hmm.
So current ratios need to
Some
be
some
one
industry,
to one.
okay, again, in some industries, there is a practice of having a relatively high current ratio.
Yeah.
The reason is that in that industry, it might be the case that you have to, I mean, the payment cycle is very fluctuating. Suddenly, your accounts payable rise, or on very short notices, you have to make cash payments.
Mm,
So, if you're operating in such an industry, then it makes sense that you operate with a high current ratio.
yeah.
But otherwise, if it's not an industry requirement, then maybe 1:1 current asset to current liabilities ratio is good enough.
Yeah.
So there is problem if the current ratio is too high, and there is problem if current ratio it falls below 1:1.
So what are like examples of liabilities?
What are the examples of liabilities?
Yeah.
If you get a loan from the bank, it will be a non-current liability because the loan that you get, you will have to pay back over a period of many years.
Yeah.
But for non-current liabilities, the most common example is if you buy something on credit.
Mm,
Have you ever done credit card purchase?
yeah.
That is current liability. The amount that you the for the amount that you have spent from your credit card,
You need to pay it
you need to
under
pay
a
it back
year.
within the next year.
Yeah.
Okay. The utilities that we consume at our home, the electricity bill, the gas bill, they are current liabilities
Mm,
because we have already used these utilities and we have to pay back this bill within the next month.
yeah.
So these are current
So
liabilities.
current liabilities have a time frame,
Again, 1 year,
and the non-current liabilities
more than
don't
one
have
year,
a time frame. Okay.
more than 1 year. They have a time frame, but it's more than 1 year.
Yeah. Okay. Okay.
Nobody gives you money for indefinite period of time. Take this money in business. Take this money and return me whenever you feel like it.
Yeah.
So all liabilities they have a time, but for non-current liabilities, it's for more than 1 year.
Yeah.
And some non-current liabilities they become so. For example, somebody gave me a loan and told me to pay it back in 2025.
Yeah.
Right now, it would be a non-current liability.
Yeah. But like in
In
2025,
2024,
it will be
in
current.
2024,
Oh,
it
it'll
will
be current.
become
Yeah.
current liability because I have to pay it next year.
Yeah.
All right.
So current is under a year, or
Hmm.
yeah,
Hmm.
under a year.
A year or less, non-current is more than a year.
Yeah.
Okay, so if you have understood this concept of current ratio, the next ratio, and you understand how this ratio it helps us identify the liquidity of the business. How much cash does the business have? How much ability does it have to pay back its liabilities?
Yeah.
Okay, so with current ratio, we do one more thing. We say, let's put a more stringent test, and this is called acid test ratio. Sometimes it's called quick ratio. So, first, let me write it down completely, and then if you want to copy it, you can. So, in denominator, we have got current liabilities, the same as current ratio. In numerator, we write current assets, but from these current assets, we deduct inventories. From current assets, we deduct inventories and divide it with current liabilities to get this acid test or quick ratio. Why do I keep putting n? It's not ration, it's ratio. Write it down, then I'll explain it.
Yes. The quick ratio
Hmm.
is the acid test.
Acid test or quick ratio, it's two different names for the same thing.
Oh, okay. Current assets minus in what was that? Current assets minus
Inventories.
inventories. Yeah.
Okay. So now the question is, why am I deducting inventories from current assets? Previously, I was comparing just the current assets to the current liabilities. Why deduct inventories? Do you have any reason in mind?
Deduct the inventories.
Hmm.
Think because you sold them?
Uh-huh. Quite the opposite.
Because you still have them.
Okay. If you look at all the remaining current, what we are doing over here, we are trying to assess the ability of the business to pay back liabilities, right?
Yeah.
And we are saying that using these current assets, a business would pay back liabilities.
Hmm.
So, from all these current assets, inventories is the item which is the most difficult to convert into cash.
Yeah.
Why? Because the other items, cash and bank, they are already cash. Accounts receivable, you already have a legal right over these accounts receivable. If somebody doesn't pay, you can take them to the court. But inventories, you're not yet sure whether they will get sold or not. In
Yeah.
ideal circumstances, they will, but I mean, the worst case scenario that could happen is that in these inventories they do not turn into cash, right?
Yeah.
So that is why we take a conservative approach. We say, what's the worst that could happen? Inventories, they won't get sold. Then what is our ability to pay back? If we deduct these inventories from the current assets, then how much money is there available with the business to pay its current liabilities?
Yeah.
Understood?
Yes.
All right, all right, all right, all right. Huh. Can you do this activity too? Is there an activity 3? Oh, there isn't. Hmm. Would you like to attempt this right now?
Yeah, sure. What's the page number? 140?
140, yes. In fact, should we do that or wait, don't do that one, 140. As long as the previous chapter.
So you said the suppliers will want to access financial
Hmm.
statements to like evaluate the
From
the
that, the all those people who are looking at the financial statements, they're looking at least two things. The first one is uh,
prestige.
profitability, and the
Yeah.
second is liquidity.
Yeah.
So, is a business earning enough profits? If a business is earning enough profits, chances that it will run into a liquidity problem are relatively lower. A loss making
What's a
business,
liquidity problem?
liquidity problem is the situation where the business is unable to pay its liabilities,
So like
not
when
having enough cash.
the current assets
Huh. Huh.
when the current assets are lower than the liabilities, that's liquidity.
When current assets are lower than current liabilities, then the business is running into liquidity problems. Yes, the business
Yes.
does not have enough cash.
So liability is when the business is paying back the current liabilities.
Liquidity is when the business is paying back its current liabilities on time.
Yes.
Hmm. Okay, there is one more ratio. Why don't we do this as well, and then together we can solve all the. Oh, oh, no, there is not just one, there is more. There is more. Okay, quickly do this one. Mm. Activity 1, page 144.
Yeah, okay. 144.
Hmm.
Activity 1, okay. Sir, the current ratios are in percentages, right?
You can give that in decimal form. Let me check the way it gives in your book.
Because I
Uh,
got 1.13.
huh, huh. Fine. You'll have to calculate for both years.
Yeah.
Yes, sir, done.
No, I'm on the second question. Sir, the equation for net profit is revenue minus the losses, right?
Net profit you're given over here, profit before tax.
Is that
Take.
net profit?
Do they tell you how much tax percentage you have to apply?
No.
Hmm, I'll have to check sometimes. Sometimes when you're given profit before tax, usually the tax rate for corporates is 30%. But in this question, just use profit before tax as net profit.
Because it says calculate the profit of for the year. Oh, margin. Okay, okay.
Hmm.
I didn't read margin. So it's net profit. So the net profit is the profit before tax, right?
That's what I'm
Times
telling
100
you.
divided by revenue.
That in some questions, when you get an exam, it tells you either ignore tax or it tells you tax rate. Usually, when tax rate is not given, it is 30% of profit. So this time, do it ignoring tax. But I
Yeah,
will tell. I'm telling you, if you have to calculate tax as well, you have to deduct 30% from this profit to get profit
yeah.
after tax.
Okay.
Okay,
Why
and to
30%?
Hmm. And to deduct 30% from something is equal to calculating 70% of this thing. So instead of first calculating 30% and then deducting it from this amount, directly calculate 70% of this amount. it would be net of 30%.
Mm.
But right now, just ignore that thing. Simply calculate the using this profit before tax as net profit.
Yeah.
Your Edexcel syllabus is relatively easier towards there in Cambridge
The
A
what?
level.
Oh, so do you have any students that are doing Cambridge?
Hmm?
Do you have any students that are doing Cambridge?
Uh, in Pakistan, since I began teaching in Pakistan, here most of the students, the large majority, they do Cambridge and Edexcel. If anybody does, they do it just at IGCSE level. At A level, I haven't come across an Edexcel student in Pakistan. One thing, uh, international students and especially in UAE, it's quite common. And I've got other students who are studying this Edexcel board thing, but the comparing for all the subjects, in fact, for math, physics, for this business economics,
Yeah.
Edexcel seems a bit easier.
Mm.
Easier in the sense that the technicality of the concepts which is taught in Edexcel is a slight bit lower than that of Cambridge. For example, these ratios they study in AS.
Yeah. Sir, I'm done.
Okay,
Except the
sir.
third one because I'll just answer.
Hmm.
I'll just discuss.
Hmm, 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 hmm. Here. So are these your answers? So for 2017,
1.13,
current
1.21.
1.13 and previous date was 1.21.
Yeah,
Acid test.
1.10, 1.18,
Hmm.
9.7, 9.6. Yeah.
Okay.
So and
Uh,
the third question is discuss. So
hmm,
it's down to like um when compared the from year 2016 to year 2017,
hmm.
the ratio has decreased, which means that the current assets,
As compared
I
to
mean,
current liabilities have decreased.
current liabilities, yeah, the current liabilities increased slightly
One thing. What would be the implication of this? It could be that a business it might face some trouble
in the
in
future.
if these current assets do not convert into cash on time because they're just enough.
Yeah,
So what if you have to pay liability a week before the current asset actually turns into cash?
yeah,
Then you'd be in trouble. So it's just enough, one thing, but still looks like they'll be able to stay afloat because in both cases the current ratio as well as the asset test ratio, even if we deduct the inventories, there are enough assets to uh, settle the liabilities of the business, so they are seemingly in a safe position. This
yeah,
asset test ratio for many businesses it's less than 1.
yeah.
because you've deducted the inventories. So varies from business to business. But the thing is that after this, we have to compare it with the industry norm.
Yes.
What if the industry norm is of around 1.5? Or
Mm.
what if the industry norm of asset test ratio is of around 0 0.9?
Yeah.
So the actual comparison that we could get is if we could compare these results with that of industry. Net profit margin also seems to have declined, and this shows that a business, the performance of the business, it has declined. Why has this net profit margin declined? It could have been for a number of reasons. Their revenue could have become, I mean, their prices could have fallen. They aren't charging as high prices for the same goods sold. That could cause gross profit margin to fall as well as net profit margin to fall. It could be that the stuff that they used to buy to make the things,
Yeah.
the raw material, that has become more expensive and they haven't been able to raise their prices that much
Yeah.
by the same amount. It could be that the operations of the business, they have become less efficient. Even then, this problem isn't, I mean, 9.62 to 9.76% doesn't seem too much of a decline. It has. No, net profit margin has increased from 2016 to 2017. Net profit margin has increased.
Yeah.
Okay. And a reason in net profit margin, let me check one thing. Have their current liabilities increased? Sometimes to expand your business, yes, the current liabilities have increased a lot. So this is in line with this. I mean, what I'm about to tell you next, this level of analysis perhaps won't be required in your exam. So the thing is that not only have their profitability ratio increased, their current ratio decline.
Yeah.
It matches with increase in profitability. Why? Because in order to expand business,
Mm.
they have got more current liabilities.
Yes.
Okay, so that partly explains, and their inventory levels have also increased. So this shows that they are going for the growth, and that is also reflected in increase in net profit margin. So they are charging relatively higher prices as compared to the increase in cost of goods sold. That could be one reason. The other reason could be that they are managing their operations more efficiently. They have controlled their operating expenses.
Yeah.
Okay, all these combined, they have led to increase in this ratio. So this is how we'll comment on that. The next ratio that we have got is gearing ratio. So gearing ratio is non-current liabilities over capital employed into 100. First, write this down.
Right. The
Gearing ratio is equal to,
sorry. The earning ratio.
I will write it over here. Okay.
Yeah.
So again, just a step back, the balance sheet of the business or the statement of financial position when we discussed, there is total assets, and those total assets they are matched by liabilities and equity, right?
Yes, right.
Okay. Equity is the investment by the owners in the business. So that's the money that is available for investment in the business. Out of these liabilities, there is current liability and non-current liability. And non-current liability. Agreed?
Yeah.
So this non-current liability, the business does not have to pay back within the next year. So this money is also available with the business for next year. Current liabilities will pay back, so we can't use it for big investments. This is the money that is equity plus non-current liabilities is the money which is available with the business for long-term investments, or the money that is secured with business, that a business would have at least this much finance available in the next year. Agreed?
Yeah.
So we are saying when we are calculating gearing ratio, what is the ratio of non-current liabilities in this total finance available with the business? Did you get it?
The ratio of non-current liabilities.
In the total finance that is available with the business.
Yeah.
Hmm. Is a high gearing ratio good or bad?
High gearing ratio is
This gearing ratio, sometimes it's also called debt to equity ratio. What is it called? Debt to
like,
equity.
so what
Debt.
does what does the gearing ratio mean? Okay.
Non-current liabilities are the amounts that you have borrowed from other people.
Mm.
Okay. Capital employed is your own money plus borrowed amount.
Wait, this is gearing ratios?
Hmm.
What does it mean again?
Gearing
The
ratio?
Yeah,
Okay. Non-current liabilities are the amounts that you owe to external parties
that is
that a business has to pay back.
yeah.
But it doesn't have to pay back within next. So these are the debts of the business
Mm-hmm.
or long-term loans.
Yeah.
Long-term loans. So when I'm calculating this gearing ratio, I am saying that what is the total money that is available with the business for investments. This business, every business, it makes investments, and from those investments it makes money, right?
Yeah.
Okay, so what is the total money that is available with the business for long-term investments? That is capital employed.
Yep.
And out of this money that is available with the business for long-term investments, how much is the borrowed money? How much is the borrowed money which they have to pay back to someone else? The reason I'm looking for this borrowed money is that sooner or later a business will have to pay back this money, and then this source of investment would go away from business, right?
Yeah.
So the higher the gearing ratio of a business, the more risky that business is,
Mm.
because they're not doing money from their own, they're not doing business from their own money. First of all, they're doing business with borrowed money, and this
Yeah.
borrowed money, I mean, first question is that why not investing your own money, why borrowing money? Somebody might say that, let's say the owners did not have that much money to reinvest in the business, that's why they borrowed. But it still raises alarm bells. The other thing is that, okay, all right, you did not have the money, you borrowed it from the external parties. Still, this is not the permanent source of finance.
Mm.
Okay, when this money goes away, when you repay these non-current liabilities, how would you run the business then? The amount of money that would be available to you for running the business, it would not include these non-current liabilities perpetually, right?
Yeah.
So that is why we calculate the gearing ratio of the businesses and we say whichever business has higher gearing ratio is relatively riskier business. Understood?
Yeah.
Okay. Um, from this data given, can you calculate the equity of this business?
Equity.
Hmm. Okay. One more thing. So the gearing ratio that we have, it is equal to non-current liabilities over capital employed.
Yeah.
Let me write it down here again, or over here I'll do the explanation. Okay. And what is capital employed equal to?
Capital employed.
Hmm. Equity plus non-current liabilities. Are you understanding these things, or is it all going above your head?
It's a little confusing.
Okay, I'll just slow down a bit. The first thing is that we have to calculate gearing ratio.
Yeah.
Okay, how do we calculate gearing ratio? What's the formula?
Non-current liabilities divided by capital.
Capital employed into 100.
Capital 100.
Can we find non-current liabilities in the financial statements of a business?
No, right?
They are given in the financial statements of a business. They're given in the statement of financial position. See, uh, so this is the extracts of financial statements of the business, and here they say non-current liabilities.
Yeah.
So non-current liabilities are usually given in the financial statements of a business.
Yeah.
So to calculate gearing ratio, non-current liabilities I'll straight away get from the balance sheet of the business. What
Mm.
is capital employed? Is capital employed shown as a separate value in statement of financial position? No.
No.
To calculate capital employed, I will have to see for look for two things in financial statement. One,
Equity.
equity. The second,
But
non-current
what is
liabilities.
capital employed?
Hmm. First, write down the formula, then I'll explain it.
Yeah.
Capital employed is equal to equity plus non-current liabilities.
Yep.
Written.
Yes.
Okay. I told you that a business, I told you for assets, the assets they can be bought from two sources. What are the two sources to purchase assets? Liabilities and equity.
Mm.
A business, where does the money come from to purchase the assets of the business?
The they borrow, right? They
Either they borrow or they put their own money.
yeah.
So if they put their own money, what is it called?
Equity.
Excellent. And if they borrow, it's called liability.
Liability.
Okay. So
So
now
equity is the company putting money to buy
the sh-
assets from.
the residual interest of shareholders holders in the business, the amount of money the shareholders have bought the shares for, and their retained profits in the business.
So it's the business's money going into assets.
It's the business's money going into assets. Yes.
Oh, okay.
Okay. And liability is the borrowed money going into assets.
Okay. Okay.
Okay. Then I said that this liability it can be divided into two parts: current liabilities
And non.
and non-current liabilities. The current liabilities I will have to pay back within the next year, so I cannot use it for long-term investments. Agreed?
Yeah.
Can I use non-current liabilities for long-term investments? Yes, at least for next 1 year. I do not have to pay back this
Yeah.
amount. This is available with me.
But
That
as
is
soon
why,
as it's 1 year, it'll turn into current liabilities.
hmm,
And then you have to
it
pay.
might not. If I have to pay this back after 5 years, then even after 1 year, it will not convert into current liabilities.
Yeah.
Okay, so right now, the source for the next 1 year, I am confirmed that this equity and this non-current liability is available with the business as a source of finance.
Mm.
So adding these two gives me capital employed.
Yeah.
This is what capital employed is. The source of finance that a business is sure or confirmed about that it will have for at least next 1 year.
Yeah.
So the business can invest it in long-term projects. This is capital employed. And
Yes.
now to analyze the position of the business, we say that this is the capital employed. In this capital employed, what is the percentage of non-current liabilities? So the higher the percentage of non-current liabilities in the capital employed, the more risky that business is,
Yes.
because they're not doing business with their own money, they're doing business from the borrowed money, and sooner or later they will have to pay back this borrowed money. So how would they run the business then when this source of finance goes away? So if this source of finance is a large chunk of the total money that they have, then the business is risky.
Yeah.
That's the concept. Now do you understand what's gearing ratio and what's capital employed and why
Yeah.
high gearing ratio
Yeah.
is
Yeah.
risky? Okay. Okay. Um, from this information given, this first half, the upper top, it is from the statement of profit or loss, income statement. So we can ignore that. This lower half, it gives me extract of balance sheet or statement of financial position.
Yeah.
Okay. Can you tell me what is the amount of equity from this information?
Amount of equity.
Hmm. To calculate the amount of equity from this, you will have to look back at this chart that we drew the other day, yesterday,
Yeah.
statement of financial position. So maybe open this chart where you copied it in your notebook, and then by looking at the chart, let me know if you can tell me what's the amount of equity for this business.
So it's the current assets minus, or the, is it current assets minus current liabilities?
That is working capital. By the
Um.
way, I told you how to calculate equity in today's class as well. I just remembered. You asked the same question at that time as well. Here is how you calculate it.
Assets minus liabilities.
Hmm.
The
So,
current assets minus liabilities.
total assets minus total liabilities.
Okay.
You asked this question and I wrote it somewhere. Maybe I removed it. And I wrote that current assets minus current liabilities is working capital,
Yeah.
and total assets minus total liabilities is
Equity.
equity. Here,
So, but is the total assets given in the financial statement?
good question. Are they?
Because it's not.
They're given broken up in two categories, non current assets and current assets. So, if you add non current assets and current assets, what do you get?
The total assets.
Excellent. And the same way you'll have to do for non-current and current
Liabilities.
liabilities.
You get total liabilities. Okay.
Okay, so what's the amount of equity in
Uh,
2000 in 2017?
around 17. It's it's 17,097, right?
Hmm, good. So, and the total non-current liabilities are 6900. See, 6900 divided by capital employed. What have they done?
Is the 21,9, is that plus that is the r- total assets or total current liabilities?
Total assets were equal to 21,900 plus 5430. You have to calculate total equity. Okay. So you have got equity and you have got non-current liabilities as well, right?
Yeah.
Equity is how much?
Equity is 17,097.
So I write over here E is equal to 17,097, right?
Yeah.
And then non-current liabilities were how much? 6,900. To do the gearing ratio, you do 6,900 divided by 17,097 plus 6,900.
Yeah.
Quickly do that into 100.
It's 690040. Wait, let me put brackets in. 2.8, 2.9.
Shouldn't it be 28.7%?
Uh, wait, oh yeah, I put 690 instead of 6. Yeah, 28.75.
Hmm. So here 28.8%. All right.
Yeah.
In the same way you can do for 2016. Can you quickly do for 2016 yourself?
Yeah. Calculate the gearing ratio, right?
Hmm.
For 2016. So how do you get the non-current liabilities again?
They're given. They're given in that chart.
The for Hildrocoms?
No, page 142. Washi tree. Mhm. 2100,
And capital employed?
4300. Yes, capital employed, you'll have to calculate total assets minus total liabilities. Plus, I mean, that will give you equity, and equity plus non-current liabilities will give you capital employed. So,
Wait,
what's
so
your
capital employed is what again?
you have written the formula capital employed is equal to equity plus non-current liabilities.
Equity. Oh, okay, okay. Is it 55.9?
It's not, it's 25.8%.
Hmm?
25.8%. What's your non-current liabilities? What's non-current liabilities amount that you got?
Non-current liabilities?
Hmm.
Oh, wait. I put non-current assets instead of non-current liabilities.
Cool.
I got 15.2.
Still wrong. What's the non-current liabilities amount that you used?
5490.
What's your
Capital?
capital employed?
35910.
Wrong. I'm giving you the calculation for capital employed. Put on your calculator. Write 20100
20100.
plus 4300
4300.
minus 3100
Minus 3100.
minus 5490.
Minus 5490.
So this is equity plus non-current liabilities plus 5490.
So you got, so you took the non-current asset plus
Non-current
the current
current plus
assets.
non-current assets.
You
This
make
gives
the
me total
total
assets,
assets.
and then from this
Then
I
you took
deduct
the
total liabilities, current
3100.
liabilities, and 5490.
Oh, okay, okay. So this is equity.
This is
Yeah, I got the
equity.
same number, 15158. I did two
One,
twenty-four
wait, 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 wait,
thousand
wait, wait,
four
wait,
hundred
wait,
minus
wait, wait,
80.
wait, wait. This is 15810. This is what? This is equity.
Yeah,
In this equity, you have to add non-current liabilities to get capital employed.
I added non-current assets.
No.
It's,
In hmm,
yeah,
in
I did 24,400 minus 8,590, and then I got 15810.
in 15810 add 45490
So 15810
plus
plus the non-current liabilities,
5490.
5490. Then 15810 plus 54, 21,300.
Now 5490 divided by 21300.
Why?
Non-current liabilities over capital employed. This 21300 is capital employed, right?
So that over 35910?
No.
Oh,
5490 over. Do you have the formula written on your notebook before you?
yeah,
It says non-current liabilities
over capital employed.
divided by capital employed. What's non-current liabilities? 5490. What's capital employed? 21300.
Oh, okay.
What did you get?
Wait. 25.7.
25.7 something. So you would
Comparing
have
this.
25.8%. Okay. Now the business, it had gearing ratio 25.8%. in 2016 and it increased to 28.8% in 2017.
Hmm?
What's your comments on that?
Wait, so it increased.
It has increased, right? From
Yeah,
25.8% to 28.8%.
yeah.
What are your comments on that?
And the increasing?
Hmm. I mean, what does this increase imply? Is it good? Is it bad? Why has it happened?
I think it's bad.
It's seemingly bad that gearing ratio has increased, so the business has become
The
riskier.
debt is higher.
The debt is higher as a percentage of total pool of money that is available with
Yeah,
the business. But sometimes when the business it goes for expansion, it has to borrow.
yeah.
Okay,
So it
so
might be
maybe
good in some cases.
hmm, so in this particular case, again, it's the same case that we were looking at before. For this business, profitability has increased, right? Remember, it's the
Yeah,
same case we were doing before. So it
yeah,
looks like that the business is going for expansion. That is why their current ratio has declined a bit because they are borrowing more. They have got more current liabilities. Their profits have increased. Profitability has increased. Both profits and profitability has increased.
yeah,
Previously, profits were 3460, now they're 3940. So profits have increased in number and profits have increased as a percentage. So
yeah,
maybe to finance this expansion, they have borrowed some more money, which has deteriorated their gearing ratio.
yeah.
Got it? What
Got
I
it.
would strongly recommend you, there is still one more thing left in this chapter. We'll inshallah do that in the next class, that is return on capital employed.
Yeah,
Okay, but I would strongly recommend you that you go through at least till this interpreting the gearing ratio till the end of this thing in the book.
yeah,
Okay, read the whole chapter once, twice. These things they are a bit tricky, they take time to sink in.
yeah.
So go through these things. Inshallah, in the next class we'll carry on from where we left today.
Inshallah.
All right, see you then.